Hello, everybody. This is part three of a topic we're already dealing with, and the finale of everything that we did. And I'll just do a revision on everything. So you might not see my face, but you see my hands and you see me doing everything I need to do. So you don't need to hear my voice, not really with the hand, face, and everything. So let's start with what we finished yesterday on part two, which was anatomy of a candle. So as you remember, we had price um, a candle looking like this, and we call this, if you can remember, we call this the wick, we call this the body, is the another wick. So that's it. We call this, if this was white, which is bullish, we call this what, this price, the open, and this the close. And we can also call this the low, and this will be the high. I hope you can see. But for a bearish candle, something like this, so you can see that I've shaded it to its black, so we're calling it a bearish candle. The same, this is the wick, this is also the wick, the body. But what changes is this is the open and this is the close. This is the same thing, low and high. So very simple, as we have said before. So that is that for that. Let me go and get the duster. So now we can say that, as we have said, the body is the colored middle part. It represents the distance between the open and the close. Very simple. The wicks are thin lines at the top and the bottom. Blah 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 blah. So as I've said before, if this is a bullish candle, the wicks is where price has gotten to, but did not close there. Price then came back and closed here, or price came all the way down here, but it could not close here and it came back up here to close here. So very simple logic. And the low of the week is just where price got to, the cheapest price that it reached before it came back. So very simple. A bearish candle, a bullish candle, I've all said that. So now we're going into, let's do, so now that we have talked about anatomy of a candle, let's go into, I've done that. Let's go into time frames. No, let's go into market sessions, days and session of different markets. So, as I've stated before, we have the forex market, we have the crypto market, we also have the futures market, we have the indices market, and we also have the we also have the stocks market. So now the forex market is 24/5. And what does that mean? Forex market runs 24 hours a day, but 5 times a week. The market closes at 10 p.m. 10 p.m. Nigerian time on Friday, and reopens at 10 p.m. to on Sunday. So we don't trade on Saturday and Sunday. So we take a weekend to enjoy our profits or losses, and we stay off the market. For crypto runs 24/7, so 24 hours a day, 7 days a week. Why is that? Because crypto is money. Money cannot hold at a single price. Money needs to keep. Exchange of crypto is every per second per second. It is very fast, very volatile, Everybody is using crypto right now. It is becoming more and more ravaging in the financial industries. The futures market is now, this is where the difference comes in. It runs 24/5, but it closes at 11:58 p.m. every single day, and then it reopens, or it can even close at 11. So it's based on how the market feels, really. So you can close at 11 p.m. and then reopen at 12:04 a.m. or 12:03 or 12, but at least you know that when the day breaks, a new day breaks, it reopens. But it's the same thing as the forex market. The indices market is the same as the futures market, and the stock market. There's something called pre-market, pre-market hours, and then pre-market hours and everything. So it usually runs. So pre-market is any time that is before 2:30 p.m., which is this is when London session, New York session opens. So I'll explain why these times sessions. So we're talking about the days now. We'll soon go into the sessions. So there's something called pre-market, which is anytime before this. So stocks they open for in real price action in real market at 2:30, and then it closes at 9 o'clock p.m. every single day for 24 days, 5 days a week. So you will understand what the significance of pre-market soon. So now in the days, every single day there are different amounts of volatility. And why is that? Because of the amount of people buying and selling currency pairs, crypto, whatever market you are dealing with. So so if you are buying at a time that people are not in the market, there is no volatility in the market, people are not buying and people are not selling in the market as often as it should be, your trade either will get stuck or will be in a range or might be affected by any single price movement that is not catered to or that is not congested. Because imagine if everybody is placing um let's say the average person is placing, they know there's about 2,000 lots volatility every single hour, and one person places 50, 500,000 lots. That is a huge difference from the usual price. So that can cause what? Hitting your stop loss for no reason, because why? It's the price is not controlled. But when you have a market that there's enough volatility that everything is in a specific range, so you are having 50,000 lots, 64,000 lots, 130,000 lots, every single person is placing in the same range, it is so much better and there's more volatility in the market. People are there to support your trade idea, because if you can notice, and if you would notice, there are so many strategies in the world. We have the SMC, smart money concept, you have ICT, we have order block systems, we have support and resistance, every single kind of strategy. Many people learn different strategies, but if 1,000 people are using the same strategy, they will place the same trade. And so if you can have more and more people that are placing the same trade as you, there is more probability that the trade will go in your favor. So let me give you the different markets and the ones that we trade. There is the Sydney session. So now these are called sessions. Sydney session. This is where all the markets in the the lower, in how would I call this? In the um in the Australia region. So we have Australia, New Zealand, Fiji, all those countries in the Pacific Ocean, Vanuatu, all the small countries and all those things trade their money. This is when they are awake and they are trading fully. Sydney session is the one with has the lowest volatility. That is number one. Sydney session runs from 10 p.m. all the way to 7 a.m. It closes at 7 a.m. So in this time frame, in this time region, Sydney session is open. So the lowest volatility will be seen from 10 p.m. to 7 a.m. Nigerian time, which is GMT plus 1, or you could say plus the equator, whatever. But this is where the lowest volatility is, and this is when all the money in those economies are moving. And it's usually the start of the week. So at the start of the week, things will be a little bit slow. But when you enter into a different hours and into different time zones, that's when you say, okay, we're trading now. So with that out of the window, let's go on to the second most, the penultimate lowest volatility, and that is what? The Tokyo or Asian session. So the Tokyo or Asian session. Now, I will give you a note that you should notice. So it runs from 12 a.m. to 9 a.m. So this is where you see the average volatility. So this is when all the Asian money is moving, the Chinese people are moving their money, the Japanese people are moving their money, everybody is moving their money in the Asian space. And there is a lot of volatility now because of the growing economies. So now note that Tokyo session now or Asian session would not be called average volatility now. It has been called a low volatility time, Asian session. Nobody wants to trade Asian session. Why? Because there is not enough volatility. But now that there is a come about of, so now note this very well and keep this in your head. This is something that you would need very much. All the money in the economies of these big countries now, because China, Japan, Korea, South Korea, North Korea, blah blah blah, all of them are growing their economies at a faster rate than the Western world. So what happens? There is more volatility, and when there's more volatility, we can trade. All we need to do is just locate the volatility and trade with our strategy. But now here comes the problem. Most people don't trade. The people that don't know, the retail traders that are all used to the former saying of only trade the London session and the New York session, which we are coming to, which are the two biggest what's it called? And the two biggest volatile sessions. Everybody doesn't want to trade the Asian session, but now the money is moving in the Asian session and it is moving up the price of what we trade. Gold, XAUUSD, silver, XAGUSD. All of these future pairs are moving like crazy. It is always the session that tells us the direction of the market, where the market is moving this week. So now what I do for Asian session, now I do not trade the Asian session, but I use the Asian session as a another probability check, another probability up, because trading is all about probabilities, where you can add confirmations upon confirmations upon confirmations to make up a postulation that, oh, this market is going to go up at this price and go down, makes your trade better. So if you can see the Tokyo session is telling you gold is going to go up today, what will you do? Even if you see during London session, the bigger volatility sessions is going down, you will see that it just wants to liquidate, where he just wants to take out the traders that put their stop losses where Asian session started, because most people will put their stop losses where they will cut their loss at the low of Asian session. What they're going to just do, because of its volatility, is to come back, hit these people out, and then go in a direction. So I can say if I am day trading instead of swing trading like we normally do, what would I do? I will place my trade when it is liquidated, give me a nice bullish engulfing candle, and I take my trade. Very simple. Very, very, very simple. So that is just that for that. So note that it starts 12 a.m. to 9 a.m. It is now a session with averagely high volatility, and it tells us the direction of the market for the day. Very, very simple. Now we go on to the Ozigidon and what we all trade, the London session. This is when all the money in Europe is being moved. France is moving their money, Germany is moving their money, Spain is moving their money, Italy is moving their money, UK is moving their money, Netherlands is moving their money, every single European country is moving their money. European countries are the beast. So what will happen? There will be, this one is the session with the highest volatility. It moves like crazy, TLT. And um, we are so blessed that we are in a country like Nigeria, that the moment we wake up and we can prepare a little bit, London session kicks in. So if you're a day trader, it's the best thing that can ever happen to you. Now, when does London session start? London session starts at 9 a.m. and moves all the way to I think it's 5 o'clock. Yes, 5 p.m. So London session is on for about how many hours is this? 8 hours, and it's moving from 9 a.m. to 5 p.m. Nigerian time. So the moment you wake up, 7 o'clock, prepare like how I am doing now, as I'm at home during the holidays. Prepare, you do everything you need to do. By 9 a.m. you're on the charts. You look for an opportunity on a pair that you would like to trade, that you have pre-analyzed, and you take your trade between this time frame. This is the best time frame to take your trades. And now for the last session, New York session. This is the fire session. Karabosoto. It's not a session you play with. It's not a session you play with. So now, what the New York session is for is just news releases, highest volatility in the market at any given point of time. So the standard time where all these news happens in New York session is by 2:30 p.m. And now all of you will be asking, why does some overlap with each other? The time overlap with each other. We will explain that later. Wait for that. The moment is 2:30 p.m. and it's a day for high news releases. What will happen? News will come out quickly. Quickly. News is going to come out 2:30 every single day. This is when all the high volume happen. So New York session is also high volume and high volatility, but the major significance it has to other sessions is when all major news releases happen. So when NFP is releasing, and now I'll teach you all the things you need to know about news, so that you also know the things you need to know about news. I think that will be another class. I don't want to deal with that now because that's too much for just this session. So this is beautiful. Now I've known everything that we need to know. Now let me talk to you about session overlap. Session overlap. This is when one session overlaps with another session, like Sydney session and Tokyo session and London session and New York session. But the one that we are focused on is the London and the New York session. So if the London session runs from 9 a.m. to 5 p.m. and the New York session runs from I think 1:30. Yeah, it's one. Let's use 1 p.m. to 10 to 8 p.m. So we can say that from 1 p.m. all the way to 5 p.m. is the time with the highest amount of volatility in the market. And this is very, very true. So what happens here? London session is in, New York session is in, news releases happen 2:30, everything happens. Best time to trade. A lot of volatility here. But when there's so much opportunity, but there's also so much opportunities for losses. So you need to be very cautious in these kinds of sessions, and you put your stop loss very, very good, a very healthy stop loss. We will talk about all of that. So now we're done with time frames and days and sessions. We're almost done. We are almost done. Now, I'll just talk to you about candlestick patterns. Then we end the session. Candlestick patterns. So now candlestick patterns, these are just patterns that we see in the market and we know, okay, this is what we're looking for. There are only two candlestick patterns that I vouch for, which is number one, the doji, and number two, it is called DOJI, doji, and the engulfing candle. It can either be bullish or bearish engulfing candle. So now these are the only two I vouch for and I look for in the chart. So when you're on your chart and now that you understand how to read candles, you see that the market is moving in an uptrend, blah 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 blah. I'm seeing a candle like this. Let me start explaining number one, the doji first. What you would see in the market. So now let me just explain what the doji is. The doji is a kind of candlestick that shows that there has not been any change in price. So if you look at this candle, you can see the body is so small. And what does that say? That means that the open and the close are very small, very, very similar. Unlike this bearish engulfing candle, that the open and the close are far away from each other. So that means there was movement in price, but it just states that there was indecision. So sellers want to sell, but buyers want to buy. So when price is pushing up, there are all sellers too at that same point. So that means that at that point, whenever you see a doji, you cannot use your rectangle on your trading view to mark that point. And that is a point where sellers and buyers are. So if the next candle is a bullish engulfing candle, you would know that the buyers now are in control. So what will you do? Wait for a retest, then you buy. So you continue the trend. So the doji is just telling you that there's indecision in the market and a change of the pattern. But this same doji candle can also sense a reversal to say, okay, we had a bullish engulfing candle. I cannot draw like this. Uh, so we can have a bullish engulfing candle, a doji, and another bullish engulfing candle. Now this formation, so this is bullish, this one will be bullish, and this one will be bearish. So this is called an evening star formation. And the reverse, which would be this will be called the morning star formation. So now let me talk about bullish candle. A bullish candle just shows that okay, these people are in control of the price. So if you see a bullish candle, you will know that the buyers are in control. You see a bearish candle, you know that sellers are in control. Very, very simple. So doji just shows number one, indecision, a continuation, a price at which buyers want to buy and sellers want to sell. Is also a change of the pattern, or you can call it a reversal. Very, very simple. So that's just that for that. Now, a bullish engulfing is just to show that either the buyers are in charge or the for a bearish engulfing candle, the sellers are in charge. So that is just it. So when you see a formation like this combining these two, doji and engulfing, when you see price moves up, gets to a range, you see a doji and you see a bearish engulfing, you would know that what the sellers are in control and you would look for a sell here, put your stop loss just here and target wherever you want to target the next low or the next low or the next point of the market that you know that this price is going to get to. Very, very simple. And also the morning star formation is the exact same thing. You take a bullish trade, put your stop loss here, and you take profit to peak. That is just it. That is just that for that. So I hope that you understand every single thing that I am saying and you can comprehend every single thing. So what have we talked about today? We have talked about an anatomy of a candle, the wicks, the the body and the high and the low and the close and the open. We have talked about sessions in the market, the Sydney session, the Tokyo session, and the London and New York session that we are most important with. The overlap is from 1 p.m. to 5 p.m. London session runs from 9 a.m. to 5 p.m. and New York session runs from 1 p.m. to 8 p.m. Market days, the forex market is 24/5, stock market is 24/5. Every market is 24/5 except from the crypto market is 24/7. Doji means indecision. It is where the market is tight, buyers and sellers are in a stalemate. It happens if this happens after a long trend, it often signals a reversal coming in or a continuous push into the upside. We have the bearish engulfing, we have the bullish engulfing, and every single thing. Now, the last thing I want to talk to you about is time frames. I didn't clean that up. I didn't even notice I cleaned that up. Time frames. So, last thing is time frames. So, we have different time frames in the market. So, we have the M1, the M2, there are so many, M3, we have the M5, we have the M10, M15, M30, H1, H2, H3, H4, H6, H12, D1, W1, M M1. No, this is the second M1, so this is called the monthly. So just M, and there's the 12M. So these are all the time frames we have. What does these M's mean? All these M's means minutes. So this is called minutes. So whatever you see after it is 1 minute, 2 minutes, 3 minutes, 5 minutes, 10 minutes, 15 minutes, 30 minutes. H is hours. So it means hours. So whenever I see one, you see 1 hour, 2 hours, 3 hours, 4 hours, 6 hours, 12 hours. Whenever I see D, it means day. Whenever I see W, it means weekly, week. Whenever I see M, monthly. Anything that doesn't have a number after it, any M that doesn't have a number after it is monthly. And this one, 12M is 12 months. So that's year. So time frames. Now this will lead us to types of traders that we have and what types of traders that we are. The M1, the ones that were most important and the most useful ones is this. So let me clean this one, this one, this one, this one, this one, this one. We don't need this one. So the M1 is the minute time frame, the 1 minute time frame. So each candle will be 1 minute worth of data. So the candle only runs for 1 minute. That's the same with the 5 minutes. A candle only runs for 5 minutes. M15, the candle only runs for 15 minutes. So you would see this on your trading view. If you go to different time frames, the M15 runs for 15 minutes. Same thing with everything. So one candle can mean 1 week of data. And so the lower you get, the more price action you would see. So you will see the most price action on the 1 minute time frame. But there's also the 30-second time frame, which all those mad scalpers use, all those people that trade sharp, 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 quick, quick. 1 minute trade, they're out. But now let's understand what we use all these time frames from. The 1 minute, the 5 minutes, and the 15 minutes are all used to what? Scalp. And we call traders that scalp scalpers. And what does this mean? Scalpers are just traders that do not trade in the long term. They only want to look at small price movement and take their trades off small price movement. They usually hold their trades for 15 minutes, no, 2 minutes, 1 minute to around 10 minutes, and they take their trade off wherever it hit their TP or their SL. So that's just for the scalpers. For the intraday traders, so intraday means in the day. So you can also call them just day traders. You can remove this intraday or day traders. They trade in the 30 minutes and the 1 hour time frame. Sometimes some intraday traders use the 15 minutes, but for real day traders that hold trade for a full day, the M30 and the H1, that is what they use to analyze and place their trades. Now, coming on to the swing traders. So these ones they hold their trades for 4 to 6 hours and they just hold it for quick. They are fast paced and just hold for quick entries and quick exits. Now for the types of traders that we are swing traders. We trade on the 2 hour time frame, the H4 time frame. So these two time frames are our time frame. These are we analyze and we take our trades on. So these swing traders are traders that our trades usually last for a few days. And why do we do that? Because we want to not just capture, we don't want to capture the full everything that's happening in the market in a week, but we don't also want to catch a small move. So we want to catch in the middle of that. So we hold trades for 2 days, 3 days, 4 days. We could even hold trades for up to a week, depending on how you want to take your profit and everything. But swing traders, now I will tell you the differences and the similarities and also the advantages one has over the other. And then we have the D1 and the W1 and the M and the M2. These ones are for position size traders. So position trading, they are holding it for long-term investment and overall trend direction. So they want to catch every single thing. So if they have made a postulation that the S&P 500 is going to go bullish, they place their trade and they keep it there for as long as they want before they take their profit. So they can hold it for months or they can hold it for weeks, 2 weeks, 3 weeks, 4 weeks, 5 weeks. So that's it. Now, these are position traders. Now, let me tell you the types of traders we are and why we trade like that. So we are swing traders and soon to be position traders. I position trade on a different account. Why do we swing trade? We swing trade because we don't want to catch too small price actions and too big price actions. Number one. Number two, the data that I have collected has proven that we have collected has proven in the FSA strategy that it works best when we analyze on the H1 and the H2 and we hold for a prolonged period of time. Unlike when we trade on these time frames, on the smaller mini time frame and the H1 time frame. Do you understand what I'm saying? This so that's why we trade. We are swing traders. But sometimes I can be a day trader. Personally, I'm trading on my own without any other capital from FSH Capital. I'm not collecting capital. Without capital from FSH Capital on my personal account, I intraday trade usually on only gold because this is where I can find the best opportunities to intraday trade. I've been placing very, very good trades. I sent the signal to the person I sent the signal to the person that that hopped on the call with me in the last this thing and we played a trade on gold and this thing is running about 1,000 pips in our profit. So we thank God for that. So now you understand why we swing trade. We swing trade because of the data that have been proven and we are better traders swing trading than intraday trading, scalping or position trading. So you would learn every single thing with us. Very, 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 very simple. So that's what I have for you today. But before you go, comment down in the comment section where you do not understand so that I can read them and I can review them and give my opinions back. And number two, if you have any problems with the transmission of our teachings, please contact us on our Gmail so that we can improve. Because I just got this feedback from one of our students. I said that the online version is not as good enough. So we'll only be doing online or going on the chat when we need to. So if we need to look at the chat properly, we go onto the chat. But everything we can explain on a board with a marker and with my voice and my face. So that will be the end of this class. I hope you have learned everything you need to learn. I know you will learn everything. We are all good learners in FSH Capital, and we want to see you train and make money with us. So get on with this course. Go to our previous videos, watch every single thing, like, subscribe, share, comment, every single thing, and we'll catch you on the next one. Bye bye.